Hello everyone. This is Sahas Academy. Welcome back to the knowledge series on economy, finance and banking. We are presenting here, episode 7, Threats of Cryptocurrency. Let's begin our discussion. Cryptocurrencies have risen due to falling trust in the present monetary system. Further, libertarians believe that the government is misusing its power and creating abundant money supply, which is eroding value of currency in purchasing power parity term. Hence, launch of cryptocurrency is an attempt to create a parallel monetary system, which is decentralized and out of control of monetary authority. Cryptocurrencies provide many benefits in terms of speed and efficiency, especially in cross-border payments. Store value function without any geographical boundaries makes it attractive for protection against government control and actions. Rising popularity of cryptocurrencies can be gauged from the rise of its market value, which was peaked at $2.6 trillion in 2021, though market turmoil in 2022 has shrunk its market value to below $1 trillion. At present, cryptocurrencies are representing very small portion of total financial assets globally, but its continuous rise and wider use for critical economic activities may pose systemic risk to economies. In this video, let's understand some of the risks which regulators and governments believe could create systemic risks. Credit risk. Private digital currencies sit at substantial odds to the historical concept of money. These are neither commodities nor claims on commodities, as they have no intrinsic value. Monetary authority-backed currencies are implicitly backed by economic resources of a country. Since cryptocurrencies are neither backed by any asset, nor commitment by any sovereign authority, it is similar to unsecured commitments. In cryptocurrencies, even this relationship is also very complex. In case of companies or any authority, investors have share of residual value of assets, but cryptos are decentralized and we don't know the real issuer. From credit risk perspective, risk involved in cryptos is the highest. Multiple currencies in circulation. Presently, one currency backed by monetary authority is used for pricing. Wider acceptance of cryptocurrencies may result in multiple currencies in use, which will make pricing of products difficult. Further, there will be challenge of interoperability as multiple platforms will exist without any regulatory controls. It will not only bring further inefficiencies, but create monopolies in walled garden, which regulators want to break in the prevailing payment system. Moreover, it will make banking difficult. With multiple currencies in use, intermediation activities of banking sector will be hampered, and it may lead to lower credit growth. Claiming the benefits of the centralization, cryptocurrencies are being hailed as innovation that would support the centralized finance. However, we believe it will disrupt the traditional financial system and create more inefficiencies. Conduit for money laundering. Since private digital currencies are outside the control of governments and monetary authorities, it can be used as a conduit for money laundering and terrorism financing. Governments and regulators across the globe are keeping close eyes on usage of these currencies. Monetary policies impacts. First, dollarization of economies. Dollarization is the term used for when foreign currency is used in addition to, or instead of the domestic currency of another country. It is an example of currency substitution. Dollarization usually happens when a country's own currency loses its usefulness as a medium of exchange due to hyperinflation or instability. In this era of digitalization, currencies of major economies like US, Europe, China will become even more dominant. Since private digital currencies are pegged to major economy currencies, like stablecoin, or valued in major economy currencies, like Bitcoin, it will further strengthen the major economy currencies and weaken emerging market currencies, even for their domestic usage. Dominance of major economy currencies may result into transfer of capital out of country, and it will create dollarization of emerging economies, which would be harmful for them and their currency management. With the digitalization, convertibility and movement of funds would be much fast. Even, it would be difficult for central banks to control and protect currency volatility, which will make monetary policies less effective. Second, make monetary policy ineffective. Since cryptos are not controlled by monetary authorities, they cannot change money supply to manage inflationary and disinflationary conditions. Moreover, central banks' monetary action may become redundant to stimulate growth. Hence, it can make monetary action by central banks ineffective and destabilize economies. Fiscal impact. With the wider usage of cryptocurrencies as a medium of exchange, it will be difficult for the government to levy taxes. Cryptocurrencies are decentralized by nature as a peer-to-peer network. These currencies will operate from jurisdictions which are low on compliance. For levying taxes, government needs payment data. In the absence of this, it will rely on voluntary compliance and reporting. This will impact government revenue and impact developmental activities in a country. Capital flow management. Widespread use of cryptocurrencies may lead to increase in capital outflows, reduced domestic savings, or diversion in foreign capital that could have been invested domestically. Most of emerging market currencies are not capital account convertible, and central banks keep tighter control on foreign exchange movement to maintain financial stability in a country. Enforcement of capital control will be challenging as payment networks are not controlled by central banks. Large capital outflows can put a country into a foreign exchange currency crisis. It will also make the local currency volatile, which will impact trade of a country. Currency volatility. Cryptocurrencies are experiencing high volatility. Weakness in currency increases domestic prices, which will lead to increase in inflation. On the other hand, strong currency impact export competitiveness. For growth and economic stability of a country, stability in currency movement is essential. Higher volatility in cryptocurrencies will have an impact on financial stability of a country. To conclude our discussion, the rise of cryptocurrencies is due to falling trust in the present monetary system. It is an attempt to create a parallel monetary system which is decentralized and out of control of monetary authority. Introduction of private digital currencies are posing threats to the society, hence, it is important to keep a check on rise of private digital currencies. Here we wrap our discussion. Thank you for watching the video. We will come up with more videos on the subject. See you with new video. Till then, bye bye.